Good morning. This is Ken Long from Tortoise Capital with a review of the weekend trading report for June 6, 2013. We have a market that is still bullish volatile. On an annual basis, using weekly RSI 14 at 65 out of 100, or high end and normal. 10-day NDX is at 48 out of 100, so right smack in the middle. Looking at the market mosaic, percent stretch relative to the 200-day moving average at 9.18 is bullish, white bullish. Slope of the 50-day moving average has declined to 0.45, so yellow neutral, weakening of the bullish trend. ADX 14's dipped under 20 now to 19.7, down from 25 last week, so the bullish trend is weakening. ATR percentage remains volatile at 1.36%. The risk index, which is the 30-period VIX moving average divided by the 10-period, is at 0.88. This is risk off, meaning avoid risky assets. The Z-score of that 0.88 reading is minus 1.61. You can see the time series of the last 90 days. It looks like a little bit of bottoming action here with a couple days where it started to improve with a Z-score greater than minus 1.5. And when this thing turns, it tends to turn pretty smoothly, and we can this would lead us to expect a period of declining volatility, which would make symbols like SPY and the market and XIV attractive. Blended monthly rebalancing still holds financials, healthcare, and consumer discretionary. 13 ETF portfolios holding smalls, mids, and the Dow 30. The next reevaluation due on or about 1 July. In ETF 2, the theoretical exposure has dropped to 50%. The model portfolio remains at 70% exposed with stops in place. Just a quick look at the top symbols in blended monthly. Right now it's small caps, large caps, and the diamonds in the 13 ETF. Japan has fallen into cash position with only the remaining U.S. indices in to buy, everything else on cash. Healthcare, financials, and consumer discretionary remain the top three in the 32 ETF portfolio. Looking at the market health check now, the vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal purple lines are price targets that were resistance levels in the past and may act as support now. The red lines were resistance levels that have become support levels. You can see it holding above 162 right now, right on 164, which is at the middle of the river, which is that 30-period Bollinger Band plus or minus 1. The floodplain is Bollinger Band plus or minus 2, but we're right smack in the middle. You can see that the horizontal black line, which is the 30-period regression line, the slope has just turned negative, and the black lines form the channel, the RAF regression channel, based on the maximum excursion from the regression line during the look back period, which was on the day of the swing high here at the end of May, so about May 21st or 22nd. For this to become a bull market with confidence once more, it's got to close above 168 and take out that swing high. That would get it up into the floodplain now, in the northern limit of the RAF regression channel. It's holding right now in the midpoint, and the market is starting to go flat here. And with the Bollinger Band pinch, this is developing into a sideways quiet channel, which means we would favor breakouts from the river in either direction. And you can see that the support levels on this ladder of support all the way down to the 200-period moving average, which has reappeared on the chart as the bull has started to stall. Let's see how ADX is pulled down from 36 down to just below 20 with the bears in charge. We've come out of oversold conditions here on Williams percent R, but are right about at the midpoint of the Williams percent R 10. And then percent price oscillator remains open to the downside, but with a slight improvement over the last 10 days or so. You can see the higher lows have been supported by the 50-day moving average. So this is developing into a sideways quiet channel market. Now, what's nice is failure to fail further and 162 holding support, but really the support here at 160 is sort of crucial to holding on to the gains of the last month, which have already substantially been erased. But to hold support there will be key, and then it'll be tactical trading back up to 168. So this is a trader's market with a long side bias, and this double lower top here will be troubling, but it does have higher lows, so we're coming to almost a triangle or a pennant formation here. So let's see which way the breakout occurs. I'm going to play this as sideways quiet channel. ETF2 regional report. 5 out of 10 are on a cash position, which puts us at 50% invested, 50% cash. The S&P at 56 is still better than the globals at 48, so now we're 8 points better. So the gap is continuing to widen between the U.S. and the globals. Inside the U.S., it's the large caps, small caps, mid caps, then tech, although there's a pretty tight convergence on the U.S. Side. The two strongest sectors, SPY, the large caps, and IWM, the Russell 2000, small caps. Two weakest remain Latin America and emerging markets. You can see in the spider extract that XLP has now joined back up in the green here on the average score. But the three best financials, healthcare and discretionary, greens across the board, looking good. World market model, U.S. remains above average. Japan has been reduced to above average. Emerging markets all weak. Asia less Japan all weak. Gold and silver all weak. Only China in Asia, plus Malaysia and Vietnam looking strong. Korea, India, Thailand, and Philippines have gone from greens to reds as money has flowed out of those emerging markets. In the global sectors, you can see the U.S. Is better than its global counterpart with the exception of utilities, and with healthcare, discretion, and financials being strong globally. All of Europe above average, only Austria and Spain lagging. Little to no change in the top 30 ETFs. The Dow 30, even the weakest of the stocks, is out of the red. Caterpillar and Alcoa still at the bottom with IBM. Winners, Hewlett-Packard, Microsoft, Boeing, Intel, United Health. Emerging strength coming in here with JP Morgan based on the strength in financials, and on 3M. Let's go back one here. ExxonMobil is sort of an emerging strength leader because it's now white on strength and yellow on consistency, so it's deeper in the value cycle here, but it's starting to march its way up the stack. And the ETF liquidity. Shifting to the daily report, no signals in overreaction or channeling. You see volatilities continue to rise. Only a handful of swing setups on the ETF side with XIV and channeling and overreaction, but quite a few in the large caps. Also some triple screens and 551W setting up nicely with Home Depot. Auto framer showing coal, gold, DuPont, Home Depot, emerging markets, Walmart, Latin America, Brazil, all testing out favorably. Again, quite a few to choose from. DuPont should be of interest with an RSI2 value of 2. It was a % loser on Friday. 3.4 to 1 on the auto framer, number 4 in our max pain range compression, and a channeling and an overreaction signal. So quite a few to choose from. A lot of reasons to be interested in DuPont. Home Depot looks pretty good also as a relatively low RSI2, but was a strength leader on Friday with 0.1% gains. 3 to 1 on auto framer, triple screen and 551W, so lots to be looking for there. In the ETFs, the only patterns show up as channeling and overreaction for XIV. A handful test out better than 3 to 1 or 2 to 1, excuse me, in the auto framer. Brazil, Latin America, silver had a good day, up 1.4%, as did the VIX and oil. Auto framer, taken to adding this back into the daily report. These are all the symbols that compute out better than 2 to 1 on the reward to risk ratio, based on a retest of the 10-day high as the mechanical price target, and a notional mechanical entry 5 cents above yesterday's high, with a stop 5 cents below yesterday's low, so that sets up a 10-cent buffer. We're looking on this one at minimum 2 to 1 reward to risk, and now it computes 3 different levels of risk. The mechanical entry with the mechanical stop is what I call the range risk. The minimum ATR risk is 0.25 or a quarter of an ATR. In this case, in coal, that's an 8-cent stop. The range risk plus 10 cents in coal is 66 cents, and then the maximum ATR risk for this is set at 1. And so what this little section here in risk calculation does is find the middle value of risk between minimum and maximum risk, ATR risk, and the range risk, and it selects, in this case, 0.33, because that's the midpoint in those 3 sections. Most of the time you'll find the range risk is the middle value, but occasionally on large range days the 1 ATR stop is the midpoint. And so this computes the reward to risk ratio based on my risk with a mechanical entry and a retest of the 10-day high. So those symbols in declining order there, or decreasing order: coal, gold, DuPont, etc. Home Depot, number 4 on our hit parade. That looks pretty interesting. The market mosaic stabilizing now sideways here. You can see the slope, the regression line is basically flat. It's come back to the 0 line here on the 30-day look back. On the 180-day look back, you can see again it's right at the 0 line, still above the 6-month average, or right at the 6-month average, excuse me. This is the 0 line for that slope. And the 10-period moving average declining as well. Oh, I'm sorry, get that back. The 10-period moving average is at 0. The slope of the 30 is right down here at 0. You can see how flat it is. It actually tipped just slightly negative here. And so we're back to the 0 line and 1 standard deviation below the 6-month average. So this sell-off here is troublesome. All of these other moves on the way up had like single point support levels. This has now formed a double, and is, even though it's a slightly higher low, this is much more weakness than we've seen in the past 6 months. The remainder of the report, just the reference data, which I'll just flash through. again, I want to highlight here on price inside the river. It spent a lot more time mucking around than it has in the previous moves, which came down, tested briefly, and then zoomed right back up. This is evidence of wearing out the bull. The 90 period regression line has started to roll over and going to rejoin the river here. The 30 is already below the 0 line, and the 10 bounced and came back to the 0 line, but is certainly getting weaker. And that's everything I want to cover for tonight. Have a happy Father's Day, and we'll see you in the chat room. Keep your powder dry and your wrist measured.